Market downturns and recessions are an inevitable part of the economic cycle. They have occurred throughout history and will occur again in the future. While they can feel unsettling, they don't have to be financially devastating for investors. In fact, for those who are prepared and understand the dynamics at play, recessions can present significant opportunities. These periods can be fertile ground for long-term wealth creation. It requires a strategic approach to investing, one that differs from navigating a bull market. The goal is to help you transform the fear that often accompanies market downturns into a clear-eyed perspective on opportunity. By understanding the phases of a market cycle, you can position yourself to not just survive a market crash, but to thrive during the subsequent recovery. This guide will provide you with the knowledge to navigate these challenging times effectively. Every market downturn is typically preceded by a period known as the Euphoria phase. This is a time characterized by widespread market optimism and confidence. Asset prices are generally rising, often reaching new highs. During this phase, it's crucial to be aware of the potential for market overvaluation. Enthusiasm can sometimes outrun fundamental value. Avoid getting swept up in the general market hype and speculation. Emotional investing is particularly risky when prices are inflated. This is a strategic time to review and potentially adjust your investment portfolio. Consider diversifying across different asset classes and sectors. Diversification helps mitigate risk if one area of the market becomes particularly overvalued or vulnerable. As asset prices climb, it can also be prudent to gradually take some profits from investments that appear significantly overvalued based on their underlying fundamentals. Rebalancing your portfolio can help lock in gains and reduce exposure to potential sharp declines. Maintaining a disciplined approach during euphoria is key. While others may chase speculative gains, focus on the long-term health and valuation of your investments. This preparation sets the stage for navigating the next phase. Following the euphoria phase comes the reckoning, which is the market crash itself. This phase is marked by a dramatic shift in market sentiment, with fear becoming the dominant emotion. Asset prices plummet significantly, often very rapidly. During this time, many investors succumb to panic. They make emotional decisions, often selling their assets in a rush to avoid further losses. This panic selling, unfortunately, results in locking in those losses at the market bottom or near it. However, it is precisely during this phase that the seeds for future investment gains are sown. The widespread selling creates opportunities to acquire quality assets at deeply discounted prices. The key action during the downturn is to remain calm. Resist the urge to make impulsive, emotional investment decisions driven by fear. Instead, focus on the long-term value of assets. This is the time to begin identifying undervalued assets. Look for companies or investments with strong underlying fundamentals that are temporarily trading at a discount due to market panic. These are often established businesses with solid balance sheets, consistent earnings potential, or essential products and services. Their temporary price drop does not reflect a permanent loss of value. A powerful strategy to implement during this phase is dollar cost averaging, or DCA. This involves investing a fixed amount of money at regular intervals, regardless of the asset's price. When prices are low during a crash, your fixed investment buys more shares. DCA removes the emotion of trying to time the market bottom, which is notoriously difficult. It ensures you are buying when assets are cheap, lowering your average cost basis over time. This strategy is particularly effective during volatile periods. Maintaining a long-term investment perspective is absolutely critical during the reckoning phase. Remember that market crashes are temporary events in the grand scheme of economic history. Markets have always recovered from downturns, eventually reaching new highs. Focus on the recovery that will inevitably follow. By investing strategically during the downturn, you position yourself to benefit significantly when the market rebounds. Patience and discipline are your greatest allies. The fear of a crash can be paralyzing, but understanding that it's a normal part of the cycle empowers you. Instead of seeing falling prices as a disaster, view them as a rare opportunity to acquire valuable assets at a discount. This perspective shift is fundamental to profiting from a recession. While panic selling locks in losses, strategic buying during the downturn sets the stage for substantial gains during the subsequent bull market. It requires conviction in your investment thesis and the ability to look past the current negative sentiment. Identifying undervalued assets means doing your homework. Look beyond the headlines and market noise. Analyze companies' financial health, their competitive position, and their long-term growth prospects. A temporary dip in stock price doesn't necessarily mean a permanent impairment of the business itself. Dollar-cost averaging helps smooth out the volatility. By investing consistently, you avoid the risk of investing a large lump sum right before a further dip. It allows you to participate in the market recovery from the moment it begins. Think of it as buying assets on sale. Just as you might stock up on necessities when they are discounted, a market crash offers a discount on ownership in productive assets. This is the core principle behind profiting from a downturn. The duration of the reckoning phase can vary, and predicting the exact bottom is impossible. This is another reason why DCA is so effective. It allows you to buy throughout the downturn, ensuring you capture the low prices whenever they occur. Emotional control is paramount. The news will likely be negative and market sentiment will be bleak. It takes discipline to stick to your investment plan when everyone else is panicking. Trust in the historical pattern of market recovery. Focus on the quality of the assets you are buying. Undervalued assets with strong fundamentals are the ones most likely to rebound strongly when the market turns. Avoid speculative investments during this uncertain time. Recessions test investors' resolve. Those who remain calm, stick to their strategy, and continue investing are typically the ones who benefit the most in the long run. The wealth transfer during a recession often flows from the impatient to the patient. The temporary nature of market crashes is a key concept to internalize. While the pain of falling prices feels real and immediate, the market's history is one of resilience and growth over time. Every past crash has been followed by a recovery and new highs. By focusing on identifying undervalued assets and implementing a disciplined investment strategy like DCA, you are actively positioning yourself to capitalize on the market's eventual rebound. This is how smart investors turn a period of fear into a period of opportunity. The recovery phase, which follows the reckoning, is where the gains made during the downturn are realized. Assets purchased at discounted prices appreciate as market confidence returns and economic activity picks up. Your long-term investment perspective is rewarded during the recovery. The shares acquired cheaply during the crash contribute significantly to your portfolio's growth as prices rise. This is the payoff for staying disciplined and strategic during the difficult times. Understanding these phases and having a plan for each is essential. The Euphoria phase is for preparation and risk management. The reckoning phase is for calm assessment and strategic accumulation of assets. The recovery phase is for realizing the benefits of your patience and discipline. Do not let fear dictate your investment decisions. Educate yourself, understand the market cycles, and develop a robust investment strategy. A recession is not just a challenge. It is a predictable event that, with the right approach, can be a powerful catalyst for building wealth. By focusing on strong fundamentals, maintaining diversification, utilizing strategies like dollar-cost averaging, and keeping a long-term view, you can navigate market crashes successfully. These principles are the foundation of smart investing during any market environment, but they are particularly crucial during downturns. Remember, the market is a forward-looking mechanism. Prices often begin to recover before the economic news turns positive. Being invested during the late stages of a downturn and the early stages of a recovery is vital for capturing the most significant gains. This requires courage and conviction, but it is supported by decades of market history. Prepare during the good times, act strategically during the bad times, and you will be well positioned to profit from the inevitable recovery. The knowledge shared here provides a roadmap. It's up to you to apply these principles with discipline and patience. Recessions are challenging, but they are also opportunities for those who are prepared to seize them. By understanding that market crashes are temporary and focusing on the long-term potential of quality assets, you can turn a period of widespread fear into a period of significant financial progress. This is the essence of profiting from a recession.